whatever it is of rising interest rates, but it doesn't seem to have slowed down demand, and obviously there's a bit of a supply issue in terms of skilled labour and so on. But there's certainly a queue rather than a queue at people's door in terms of getting stuff done, rather than people hunting for business.
And that's another point, which is like the labor market. On the one hand, we can say the labor market is very tight, unemployment is very low, and this does not bode well for a recession.
Mm.
You know, it's an employees market in that sense. And so with such tight labor markets, yeah, things could slow down a bit, but we've got so much employment.
Mm.
Now, you could also argue, oh yeah, well, at the peak of tightness of the labor market is the turning point. And be careful thinking that it's going to continue to be tight, because it goes in waves. But it doesn't go in as when I look at the labor market graphs, they don't move in big waves except when emergency, big events happen.
Mm.
Okay, so labor market.
Yeah, well, the Treasurer in Australia, I think it was today or it was yesterday, was talking about, I think they were targeting a couple 100,000 in very round numbers of immigration this year, mainly skilled visas. Well, when I say skilled, not necessarily professional skills, but it could be basic trade skills and so on. Whereas the Treasurer today, I think, effectively said it was around 300 that they're likely to get. So they're obviously loosening. They're under a lot of pressure, right, to loosen that. Now, if you have an extra 100,000 people coming in to a country with 25 million, then that's a lot of extra housing and a lot of extra demand, and as well as students returning that haven't been here and so on. So all of those things don't augur well, don't sort of position you for a recession, right? It's sort of the opposite. It's going to be plenty of demand.
Yep. So importing labor is, let's say that's loosening the labor market a little bit, but also bringing in demand for housing and stuff like that.
Yeah. But there's so many jobs. Like all the major companies in Australia have, pretty much in all the retail stores will have signs out saying, we're looking for people. So there's if you want a job, there's a job there, right? There's no unemployment in that context. Like the stats will show unemployment, but that's not the reality.
All right. What about others? Some other thoughts on these ideas or any other observations that you guys have made?
Just to continue a little bit on what we just talked about, one interesting thing is to see what effect it's going to get that, some big companies, specifically big tech companies, are starting to cut staff. Because at least what it appears like is that the COVID shutdowns hit smaller businesses rather than big businesses. And governments said, or at least in the West, they said they would support, pretty much anyone. But what it effectively became was support for big businesses, which could, file everything and get the claims, and support for the consumers to keep up demand. While smaller companies, they basically, I don't know exactly how it is in the US, but I've heard many stories in, let's say, Sweden. Smaller companies, they're not getting the money from the government, which they were promised. And given that they were promised that money, they, kept a lot of staff. So now they're sitting in quite bad situations, even though the demand is maybe recovering a bit.
So one of the observations I've made as an analyst over the years is that every down cycle strengthens big business. Think about the property sector in Thailand when it's gotten wiped out in the past. it's the big guys that survive because the banks provide them financing, the government gives them support, they've got their brand name, and then they capture supply shrinks of all the small, medium-sized players that came into the market, you know, when times were good. Now they all get wiped out. The bigs survive, and then they can raise prices. So one of the things that you're talking about is the consolidation of power and profit into the largest businesses, and now they're in great shape. You know, look at that net profit margin of 10% across, you know, most companies, and you know, it's just incredible, and it's not falling. So I think that I think is another reason why we may not have a recession, is because these profit and loss statements of these companies can bear increased prices. They can bear a slowdown because they got a lot of cash. They got a lot of margin. They're not operating on a really slim. Think about when you get competition at the peak of a market. Yeah, there's profit to be made at the peak of an economic cycle, but there's also a lot of supply coming in, destroying the margin. But here we don't have major destruction of profit margin, and therefore it's like Jamie Dimon says, fortress balance sheet of JP Morgan. I would say in some ways you have fortress balance sheets of the big company. And then you talked about support for consumers to keep up demand, and government providing that, particularly in the West. And then the idea is, of course, that demand then goes to the big businesses. All right, what about any others? You guys got any other thoughts from the rest of the people on the call?
I have another, which is more that we would go into recession, especially if we look at Europe. I mean, part of the issues Europe has been facing is growth and demographics, and basically nothing of that has been resolved. And now they're then also raising rates to stifle inflation. So wouldn't that, you know, mean that Europe are heading into the worst time in a very, very, very long time?
And this is an interesting one, like how much abuse can Europe take? I mean, inflation at that high of a level, you know, energy scarcity, you know, industrial sector wiped out because of the cost of energy, pressure from the US to sever ties with Russia, or not, or sorry, with obviously with Russia, but also, you know, nobody's encouraging German companies to strengthen their operations in China. It's like, how much more abuse can they take?
Seems to be what they like.
They like that. All right. Others, what do you guys think? What we're discussing is, are we hitting a recession, or are we going to have a soft landing? So far, the arguments that we've had are more in favor of a soft landing, saying that the US Democrat Party's going to pump things up. An example of what they did before, like releasing oil from the Strategic Petroleum Reserve. The second argument, reason why we may not have a recession, is that everybody's expecting it. So it's in the price. It's already in expectations. That adjustment has been made. Number three, there's enormous cushion in the West to absorb hard times. And that cushion may be enough to get through the next crisis, or it could be that people are not prepared for what's coming. So that's kind of a neutral one, let's say. You know, we're not exactly sure how to read that one. And then we talked about how labor markets are tight. How can you have a recession when labor markets are tight? Because even if we lost 2% and unemployment went from 3 to 5 or something, still it's not like a crisis. The next one we talked about is consolidated power into the big businesses, that they've been getting power and profit, and the small, medium-sized businesses have been wiped out from COVID, and therefore the big businesses have the balance sheets and the P&Ls and the profitability to absorb it. And then you have Western countries have supported consumers to prop up demand, and maybe they'll continue to do that. There was no propping up of demand in countries like, let's say, Thailand. The other thing that I think you can argue in favor for a soft landing is that the US banks are in great shape. They are really, really in good shape. The last time I looked at them, and I want to do some research on them, but the last time I looked at them, they had between 10 and 15% of their balance sheet in cash. The highest that they've ever been was 20%, which was by about 2018. That's incredible. I mean, banks used to only have 3 to 5% in cash. So to have, let's say, 15 to 20% is enormous. So let's just say the banks have about 15% of their balance sheet in cash, and then another 20% is in government bonds. You know, who's going to buy all the government debt? It's the banks. Remember that the Fed cannot buy directly from the government. They have to buy through the banks. So the banks are a conduit, primary dealers, but also they're holding that on their balance sheet because of the risk-free nature of it. It doesn't put any pressure on capital. So you got 20% in that, 15% in cash. You've got 35% of the balance sheet of US banks are in risk-free assets. And they haven't been lending for the last 10 years. Their loan growth is tiny. And so you could argue that that the condition of the banks means there's no financial crisis. So that means that dominoes don't start falling like they did in 2008 or like they did in 1997 here in Thailand. Now, I don't think you can say the same thing about European banks. I think they're much more vulnerable. And therefore, it could be that that could be something that causes the European countries to suffer more. I don't know.
So it sounds like the US banks should be buying European banks.
Yeah, it could be.
Like because you say they're in great shape, but you're talking about shape in a risk sense, not in a necessarily an upside sense. If their loan growth's slow and they've got too much cash.
Yeah, I'm taking notes there on that one. Yeah, I guess what I'm trying to figure out is how vulnerable are they to a downturn.
Yeah.
But still, I mean, their profitability is really good too. That's what's kind of amazing, because every time that banking crisis happens or economic crisis happens, governments let banks reduce the deposit rate down to almost zero and get almost free funding off the backs of the individuals. And that's how they maintain profitability until they come back out of, difficulty. Amit, were you going to say something?
So if USA can make Europe energy dependent, why not they can make money dependent, finance dependent, since the banks are so strong in the US. And like how he said, maybe they can buy off the banks and control the whole Europe financially and with energy also.
One of the questions about that is, do US banks really want European banks? Or is it too much regulation, too much trouble for not enough profit? That's a question I don't know, but it is possible that they could buy these up.
Consolidate.
Yeah. All right. So, all right. A point
Sorry.
coming in. Yep. Go
So
ahead.
I was just going to. The topic that didn't come up was China's sort of pivot in the last week or so in terms of opening up again and letting the virus smash through their economy. And you know, some of the press, at least locally here, is talking a lot about the fact that it's not just about the COVID rules; it's also about embracing trade and trying to be, a level of transparency at least, or greater transparency, and sort of a we're back in the game sort of thing, and trying to push trade wars aside and so on. So, like there was a lot of talk previously about the inflationary side of trade wars and just friction in the system because of all these different issues. And do we end up in a scenario where that disappears? That obviously puts downward pressure on inflation as well. And China may look to stimulate their economy substantially, so people sort of don't get as obsessed with the fact that they've been locked up and all the restrictions that they've got. If people are happy and working and earning money, then that leads to a lot greater stability as well. So anyway, I haven't thought this through, but this seems to be a new thing that has obviously emerged very quickly. So it'll be interesting to see how it all sort of unfolds.
Yeah. So let's try to summarize that. So China recovery, demand increases, imports of commodities increase, exports start increasing, activity starts increasing, travel starts coming out, and they stimulate the global economy. That's one possibility. I was talking with my Chinese friend. We had a half an hour talk last week. He's in Chengdu, and he was depressed. Like, it's still difficult, and most places are not open. And so if there's an opening coming, it could be 12 months of positive impact on the global economy. So that's the first potential impact from China re-entering, is they bring global demand up, and that you're not going to have a recession if global demand is not collapsing. But that's just one part of China recovery. The other part is, like, how strong is it going to be? And that type of thing, which I don't know. I'm not sure. I'm just going to take some notes while you guys are talking or thinking.
It'll also be interesting to see the Chinese people's reaction to all of this. You're saying before about the lack of support in countries like China and India. So does that mean that they save more, or do they still continue to spend a lot, basically, rather than save? Okay, purely anecdotally, they seem to be very, a strong consumerism creeping in, as they've built sort of basic levels of wealth, as opposed to wealth that's going to sustain them in retirement.
I mean, my impression is that they're big savers, but I don't know. Let's look at what Pudecha says. I'm just wondering why the labor market is so tight. My thinking is that there's fewer people looking for jobs due to death from COVID, retirement, excess savings, or people got rich during 2020, 2021. However, I think with asset prices crushing down, removing excess savings and wealth, shouldn't people come back to work? And then my guess is we would need to see how the Fed would manage liquidity from now. I don't think inflation is tamed yet, given the low energy price, because Europe was not as cold as usually expected. If they hike more than the dot plot, or even only keep it high for longer, we might see a recession. So I think that one of the reasons why we could see a recession is that oil price spikes, right? That's definitely would drive up inflation and reignite inflation and scare everybody that, let's say, the Fed is going to keep rates high. It's such a difficult one because I think the OPEC members want to see oil prices much higher. And with the, cutting out of Russia, it seems like that, I don't know, I'm curious about what the real outlook is on oil, and I haven't done much work on it recently. The labor market is such a fascinating one because I just feel like it's first of all, education has been collapsing in the US and in many places where they've taken serious hits from COVID. So you could have this wave of, 15-year-olds or, 12-year-olds or 20-year-olds that, are coming into the workforce having really a whole different mindset about work, about survival, about job. And it's very possible that there was damage done to the workforce. The guy that I have, my weekly podcast with the Deming Institute, and I meet with a guy named David Langford, and he's an expert in education. And he's like, there's like 3 million young people in America, students, who have disappeared. They have not come back to school after the Zoom period. And you just think like the damage that's happening to the workforce. And it's not just the pandemic. I would say the pandemic caused another problem, is that everybody got into their phones, their devices, their computers, and the attention got destroyed too. And so it's hard to find people that can focus. And so that's another potential impact on the labor market. All right. Any other ideas? Any other thoughts that people want to share? What I'm going to do is I'm going to take this, and Alex and Chris and myself will start putting this into some structure, bringing in some charts and graphs to help us think about it, look at it, and try to make some conclusions. And then we'll record a video that we'll release to the members by probably Tuesday or Wednesday next week. And then we'll also release it then a couple days later as a podcast. And then we'll be talking about it. So that's kind of what I would say is our next big thing. So, all right, that's it for tonight. Does anybody have any questions or any other things they want to talk about? Feel free to raise those things now. Okay, wait.
Yeah, I'm just wondering, okay, because what I see in Malaysia, right, over till the fourth quarter of last year, right, after the 2 years of COVID, right, it seems like people are spending their savings, okay, and because of the interest rate, right, they foresee that the interest rate is going up, and with the high inflations, right, food and goods, right. So people tend not to buy property anymore, and they rather go for rental of property with a very short tenure, like 1 year or 6 months, that kind of thing. So it's like to me, it's like I think a lot of them is like in preparation, okay, for what they going coming is worth lah. So they also don't want to be incurred themselves with high debt burden, okay, by taking into that obligation, you see. So that is basically the scenario, okay, that I see. And with COVID that actually happened in the past 2 years, right? I don't think so. If let's say there is another knee-jerk reaction to the economy, right? Will there be sufficient, even the government, right, globally able to pump prime the economy? Which I think because in Malaysia case also we are very tight. I don't think so we can pump prime anymore. So there's a lot of actually tightening in spending and all this.
Yeah, well, that tightening in spending is part of one of the reasons why Cam Harvey's saying that the inverted yield curve may not signal, we may not get that recession, is because, first of all, financial professionals know that's a super reliable indicator, and so they're adjusting. And the second thing is that individuals are adjusting way ahead of this recession, and therefore they're spreading it out over a longer period of time, which means the bottom of the recession is a soft landing rather than a crash. It's not like they're being caught by surprise, like what happened in 2008. And I would say in 1997, there was a lot of people just caught by surprise with what happened. So this is like a slow burn that may mean that people are adjusting for it. That's one idea. All right, we got some work to do on that. All right, any other questions, any other topics that you guys want to discuss for a little bit longer, or anything else? All right, then we are done. That was a great session to kind of think things through. And then now we'll do our work on the research side to try to come up with our thinking on it. And then we're going to share that with the community. And then let's continue up the discussion.
Thank you. Good night.
All right.
Bye-bye,
See you
everyone.
guys.
Okay,
you.
thank you. Bye-bye.
Yep. Bye.